Thank you so much, and I appreciate you, and I really appreciate you allowing me to be here. Folks, I have an amazing class for you today. I have some really good stuff, and I just want to add something to what Jeanette said. She said something about leaving it alone, not being glued to the screen this summer, because what I'm about to show you, these are one-week trades. You set them, and you forget them for a week. So everything we're going to talk about are one-week trades, all right? So let's get into it right now. Today's class is going to be called Identify Monstrous 1,453% Breakouts Before They Strike. Everybody's an Einstein. Everybody can see a breakout after the fact. Everybody can see what happens after it already happens, after the stock already gained 1,000 points or 1,000%, but nobody does it beforehand. And that's what we're going to talk to you about today. That's my mugshot. I'm a retired hedge fund manager. I'm a head trader and senior publisher for Wealth Press, and I've been doing this for about 25 years now. Let me give you a little bit. I have a lot of stuff, and I mean I have tons and tons of stuff to get into today. So let me give you a very quick introduction. It's kind of interesting. I originally started trading when a good friend of mine exposed me to the market. I come from a blue-collar family. My parents were not investors. I think my mom got her 401k when she was 50 years old, just started. So my parents were not model investors, all right? But I had a friend who really exposed me to the stock market. Unfortunately, he exposed me to the stock market literally after I applied for law school. So while I was getting into the stock market, law schools were reviewing my application. And by the time I realized I wanted to be a stock trader for the rest of my life, I got accepted. So I was in a situation where if I start something, I finish it. I finished my law school. I got my graduation, and I never practiced law. From the moment I finished my education, I got a job at a local brokerage firm. I started my own brokerage firm 6 months later. I started 2 hedge funds, and the rest, as they say, is history. So I have a lot of training. I have a lot of education, and my specialty is system testing. I back test algorithms going back 20, 30, 40, 50 years. At one point when I was running my funds, I had a group of MIT grads doing back testing. So everything we're going to talk today about is backed into statistical data. I'm going to show you 3 things today. I'm going to make you very, very, very strong promises. 1, I'm going to show you statistical data that you have never seen before and you will never see before. Everything I show you is going to go back many, many, many decades and centuries, not centuries, but many decades. So you're going to see data, quantifiable data. You're going to see what really works and what doesn't. Traders have a lot of opinions. They have a lot of theories. They have a lot of innuendos, but I'm actually going to show you data. That's number 1. Number 2, I'm going to teach you things you can apply to the market immediately. And I mean immediately, right away, first thing Monday. You can use what I'll teach you today no matter whether you buy anything from me or whether we leave each other and say goodbye and you never hear from me again. You will be able to use stuff you learned today. And number 3, if you listen to what I have to say, I can virtually guarantee that you will make money, okay? No jokes. I'm not kidding you, all right? My goal is to make millionaires today, all right? So let's get started. Let's get into the housekeeping. As Jeanette said, your guys are going to be seeing a lot of these today. Access to this class is for educational, informational purposes only. If you guys have money to invest, talk to a broker, talk to a financial advisor, talk to your wife. Don't make decisions with your savings. It's not going to end well for you. Trading is a mind game. There's a lot of psychology involved. And if you're trading with a lot of money, you're going to make bad decisions. And if you make bad decisions, it's going to be over for you before the game starts. The key to trading is staying long enough in the game, to learning what to do the right way so you can eventually profit. Now, something really, really important, and this is very important, paper trading, all right? Paper trading is like riding a bike, all right, or surfing. I can read about surfing or riding a bike all day long. I could be an expert. I could write a book about bikes and surfboards. But unless I get in on one, unless I ride one, I'll never know how to do it. It's one of those things you have to actually do. So if you want to learn about a strategy, if you want to learn about a system, if you want to learn about a propensity of something, paper trading is amazing if you want to see how something works. But if you really want to learn how to trade, you need to have that emotional control. And that emotional control only comes from you actually doing it. Doesn't mean you have to start with $10,000. Doesn't mean you have to start with $100,000. But start with a small amount of money to get your nervous system used to trading. All right? Please, please, please listen to what I'm saying. Remember, I was a broker, then I ran a fund, and then I got into what I'm doing now. So I have experience dealing with clients, and the biggest problem when I was a broker, the biggest issue was they were Einsteins when it came to paper trading, and then they would start a big account because they thought they were geniuses, and they didn't know how to handle their emotions. So understand, start real small, get your mind used to the stress. Just like riding a bike, you start riding at 2 miles per hour, 5 miles per hour, 10 miles per hour, and you go on and on. So in the next hour, I'm going to show you how to find stocks and options before they experience explosive price moves, not after, before any indicator identifies them, before big money on Wall Street targets them, before all that happens, all right? It's no fun afterwards. Everybody knows about it. It's on CNBC. It's common knowledge. This is what I'm talking about. Entry date, March 13th, all right? Breakout date, March 19th. Profit, March 24th. If you got in on breakout dates, you would not even break even, all right? Notice we got into the trade before anything happened, at all. 30% gain, 7 days, Horizon Pharmaceutical. Can you imagine making 30% in 7 days? And again, I said it before, I'll say it again. Everything we do is held for 7 days. No more. We get in on Monday, we exit the following Monday. So don't ask me how long we're going to hold a position. We hold a position for 7 days, all right? Now, if it's doing really well and if it's killing it, then we hold it for another 7 days. This is no day trading. This is no, let's get in on 10 o'clock in the morning and get in at noon. We don't want you to be a slave to the market or be locked to the computer screen. All right, 34% gain in 21 days over stock, all right? Notice when we got in on the stock, nothing was going on. It was the 22nd of April, nothing was going on. If you waited till getting in on the breakout date, forget about it. Forget about it. And that's trading the underlying. If you're trading the option, oh my God, talk about the volatility crush there. So imagine for a minute if you can identify stocks before they experience those explosive price gains, before they rise. Look at this stock here, all right? August, nothing is going on, nothing. Lifeway Foods, it just explodes from nowhere. 54% gain in 28 days. Look at that beautiful trend. By the time Wall Street got wind of it, it was 2 days before the profit target got hit. 54% in 28 days. Can you imagine? Just imagine for a minute what 54% in less than a month yields you. All right? I mean, February is a 28-day month, but usually 28 days is before less than a month. So 54% in 1 month, that's mind-blowing. That can buy you a lot of vacations, a lot of freedom. That can do a lot of things for you and your loved ones, all right? So I've always wanted to figure out what drives the price of the stocks before the big price move begins. Before, not after, not during, not when everybody on CNBC knows about it, not when every charting software company's talking about it, not when it's on the cover of Yahoo, not when it's on the weekend edition of Bloomberg, none of that, all right? So take a look at NVIDIA. Remember, NVIDIA was one of the biggest darlings of the first part of 2018. It was a hot stock. I mean, really hot stock. Classic breakout, okay? Look at this, trading above the 50-day moving average. That blue line is the 50-day moving average. That's an institutional barometer for strength. Every hedge fund looks at the 50-day moving average to see if a stock's trading below or above. And you know what they do as soon as the stock trades above the 50-day moving average? They buy. They buy. So you enter right above the high, you know, the classic wait for momentum to go on, wait for the stock to continue going higher, and you wait and you wait and you finally, and by this time, it's on everybody's radar. Everybody, I mean everybody's radar. Volume is probably double that day. Your profit potential is greatly reduced if you buy after the breakout happened, after the fact, after everybody on Wall Street's telling you it's a good buy, it's a good buy, this is the hot stock. All of a sudden, it wasn't yesterday, but now it is. And now everybody on Wall Street's telling you to buy it. Now it's a darling. Look at this. And folks, this gets everybody. Don't think guys like me are immune from this. Look at this example. This is Charles Schwab, all right? An amazing stock. We have a beautiful double bottom. The second bottom is higher than the first one. It's a nice little ascending triangle. If you looked at the longer term chart, it's got a nice flat top breakout. You got a cup, cup and handle, kind of a lower bottom there with a little swing low, probably off by about 5%. It's a classic flat top breakout. This is what everybody is taught to buy, all right? But what happens a week later? All gains are erased. Everything's erased. There's no more profits. There's nothing else going on. It's done. All right? So there's a major, major downside to breakouts because they only work 30% of the time. Yes, you're saying, no, that can't be it. That can't be it. That's impossible. That's impossible. Well, folks, I got something to tell you. All right? I don't know how long you've been involved in the stock market, but look back. Look back historically, all right? Look back historically at the stock market, and you'll find something interesting. You'll find that the stock market is a counter-trending market. It's not a trending market. If you want a trending market, look at the Japanese yen, okay? If you want a trending market, look at the futures. Look at something like currencies. Currencies trend best. All right, followed by futures, then commodities, then stocks. Stocks, because there's so much random noise in the stock market, all right? They only trend about 30% of the time historically, all right? Stocks are range-bound 70% of the time. That means they just go side to side, side to side, side to side. So there's nothing going on, all right? Nothing going on in the stock market, all right? So this is what typically happens. You buy the breakout, you get stopped out. You buy the breakout, you get stopped out. You buy the breakout, and you get stopped out again. And then after you do that about 10 times, you decide to change the system because you believe the system's broken or breakouts don't work. But no, it's just the way it is. So breakouts work about 30% of the time. Market stagnates about 70% of the time. And there's nothing you can do about it. It's just the fact of nature. All right. And we'll get into this in a bit more. But majority of traders, this is a very, very good example of Apple. All right. Majority of traders bought near the high. They didn't wait. They bought near the high. Look at what happens 7 days later, $12. The stock declines $12 in 7 sessions. All right. 7 sessions. Now imagine for a second. Imagine, what if you can buy Apple not at the $182 level? What if you bought it at the $160 price level? It would be hard to mess up. Even if you messed up, you'd still make money, right? I mean, we're looking at a chart, not buying at a breakout. So, major advantages to buying early. You capture a bigger, much bigger piece of the price movement. You can get ahead of the big move. You're not competing with technical traders. Your risk level is substantially lower. So there's a huge upside to buying early. And we haven't even begun, folks, we haven't even begun to talk about options, okay? Whew. Now, if you're an option trader, you know what happens when you buy during a breakout. You're dealing with overvalued options, overvalued, overreactive implied volatility. And unless the stock continues to go up at that same rate, forget about it. You're talking about what's called a volatility crush. I'm positive you've seen it. You buy an option, the option was worth $2, then it becomes worth $4, then it becomes $6, then you buy it, and the next thing you know, it's at $1. It happens all the time. Why? Because options overreact. Options take into the expectation of the future price of the asset, okay? So when you're dealing with options, it's a whole different story. Options are playing what will happen in the future game. And when the stock is rising and when the option's doubling in price, the only thing option traders are thinking, it's going to continue going there. And that's what happens. So you're in a pickle. So, and that's a problem. Unless you know when price will rise, it makes no sense to buy early. So it's a catch-22 situation. If you buy in a breakout, then you're a swing trader. You're an active trader. If you don't buy in a breakout, then you don't know when the hell the market's going to break out. So you're a buy and hold investor, and the whole reason you're doing this, the whole reason you're watching what I'm showing you right now is so you wouldn't have to be a buy and hold investor, right? I mean, what's the fun in buying a stock early and sitting on it? There's no fun in it. It's not fun at all. And options, folks, what happens when you buy options early, okay? What happens when we buy options early? It's like buying ice and sitting on it without it being in a freezer. We all know that, right? It'll decay. It'll just sit there and sit there and sit there and decay. And you know what the worst part is? I'm going to tell you what drives me nuts. Really, really drives me nuts. Not making money is okay. It happens. Bad trades happen. Leaving a little money on the table happens. All that, that's part of the game. But buying an option and being right on the market direction and then seeing that option wither away, just wither away. And by the time the stock gets to your profit level and you're thinking to yourself, if I just bought the stock, at least I would have at least made 5% or 10%. And if you're thinking to yourself, I should have bought the option with a longer time frame, because if I did, the option would have doubled or tripled. But now the options basically break even. So you were right on the move, you were right on the market direction, and the option is worth exactly what you started with or less, and that's on a good day. And now you're getting out, you're breaking even, and all your buddies are doubling or tripling their money because they bought an option with a 3-week further expiration. So you're completely right, you're completely accurate, but you're running out of time. It's happened to everybody. Why? Because that's what happens when you buy early. So you're doomed if you do, and you're doomed if you don't. You buy in a breakout, and you're buying too late. You're buying an option that's overvalued. The stock is way over, above its fair value. It's not a good situation. You buy something when it's undervalued, and then you have to sit, and then next thing you know, you're a buy and hold investor. And either way, it's not good, right? So that's not me, but it kind of looks like me on the left-hand side. But let's just pretend it's me. It'll be more fun. It's Saturday morning. What the heck? So I went on a quest. I had resources available to me. I actually had guys who knew what they were doing. I said, guys, let's go to work. Let's go on a quest. I started a research project. The things I'm going to show you right now will blow your mind away. And folks, I'll finish a little bit early so we can go through all of this, okay? So I can go through all of this with you so I can answer your questions. I'm not going to answer questions during the class because I just have so much to get through, all right? So I literally went on a quest. Folks, this would be a good time to take your pen and papers out, okay? So how did the most popular trading and investment strategies do compared to the S&P 500? I needed a baseline. Everybody needs a baseline. If we don't have a baseline, we have nothing to play with. We don't know if what we're doing is good or bad. We got to start somewhere, right? So I know you're probably going to say, nah, this is not true. I can't believe it. This is wrong. It's rigged. It's not, okay? If you don't believe me, see it, look at it yourself. Now, this is starting January 2nd, 1999. I believe this went up to just a few months ago. This is not current, but the market really hasn't changed much. So you're going to find something very close to that. It may be now 5.95. It may be 6.01, but I promise you, it's not going to be very far from this. So in a nutshell, between then and now, the S&P made 207.77%. That's 5.98% annual return. So if you sat in the S&P, if you got into the S&P 20 years ago, 2 decades ago, you'd make 200% on your money. It's not bad, right? I mean, it's not as good as investing in real estate in California. I'm from California. I moved here to Florida. I'm in Florida. I moved here about 11 months ago. But, I mean, it's okay. It's not going to rock anybody's socks off. It's not explosive gains, but that's the baseline. That's what we're starting with. That's what the game begins with, all right? So here's what I did. I took 34 strategies. I took 17 fundamental strategies, and I took 17 technical analysis strategies, a total of 34 strategies. Not 2, not 5, not 10. I wanted to go to the drawing board. I wanted to get to the bottom. I'm one of those guys. I have a real type A personality, and I wanted to get to the bottom of this, all right? And I had the machine power and the brain to do it. I had, not my brain. My brain, I don't know about my brain, but I got guys from MIT grads They knew what they were doing. So here's what they did. We started with the fundamentals and we went to the technicals. And folks, these are strategies that most of you know about, all right? Here's the criteria for my test. Most popular, well-known strategies, ones that could be objectively programmed into a computer, and ones that we can confirm historic returns over time. And again, I went all the way. I wanted to see if I was missing something. I wanted to see a baseline. I wanted to see historic performance. And then I wanted to see what I could do. So I went on this journey, and it took me a long time. So notice this chart. S&P 500, we have the baseline up and top. And the year-to-date performance, again, it's not up to date. It's not as of Friday. It may be off, but we're taking 20 years into account. So it doesn't really matter what happened last week or last month because we're looking at 20 years. So I wouldn't really look at year-to-date. I would really look at the annual average return. That's the important part. So what do we have here? We have Martin Zwick, T. Rowe Price, Bill O'Neill. That's the guy who runs Investment Business Daily. Top earnings per share. Neff, Warren Buffett, Peter Lynch. Everybody that you guys know, everybody that you've heard of is on this list. If you were to put these 17 guys on here, these would probably come up as the 17 most popular fundamental investment strategies. And again, why did I want to do this? I wanted to do this because I wanted to create a baseline. I wanted to compare it to something, and then I wanted to see if I'm missing something or if I could take part of it and adapt it into my strategies, all right? And if you can, I've done that before. I've taken a part of something and I've adapted it and another part of something, and then I created this Frankenstein, and it was an amazing system. So to cut to the chase, how did these things look? They were, I mean, compared to our baseline, they were amazing, right? They were, I mean, what, 2.5, 3 times better? They were very good. I mean, I was very happy with these numbers. And remember, this is conservative stuff. This isn't stuff, this is not retiring rich kind of stuff. This is the fathers of fundamental analysis. This is what they do. This is what they perform. And the best performance was William O'Neill, the guy who wrote How to Make Money in Stocks, and the guy who created Investors Business Daily. So 18.8%. I believe Buffett was slightly behind him, 17.2%. So the numbers were very solid, very respectable numbers. Nothing bad here. Everything's kosher. The numbers are really, really good. So that's the fundamentals. Remember the top one, 18.8, okay? Now we look at, the font is a little different, but the info is the same thing. And again, I wouldn't really look at year to date. It doesn't really mean anything. We're looking at 20 years, okay? So look at the right column. We got the S&P 500. We got the moving average, the modified RSI, channel breakout, momentum trigger, Bollinger, stochastics, Keltner, Aaron, Chaikin, MACD, rate of change. I am sure if you guys go to your technical analysis platform, you will find 90% of these. So which one won? The modified RSI, all right? The modified RSI won 22.4%. So we beat the fundamentals. And folks, this is the RSI oscillator, and modified, we changed the standard 14 days to 10 days. That's the only modification that we did. It allows you, when you go and set the indicator, it allows you to set the days, the look back period. And this indicator was originally created for the commodities and futures and forex, not forex, commodities and futures market, which included forex before it was forex, when it was just currency futures. So we changed it because our look back period, because the stocks are a little choppier, so we changed the look back period from 14 days to 10 days. But that's the only change we made. No other changes were made. And again, we have all the big ones here: moving average, momentum, Bollinger Band, stochastic, MACD. Nothing that you haven't heard of, nothing exotic here. 52-week breakouts. I mean, folks, nothing here is exotic. And we did slightly better. We didn't do a whole lot better, but we did slightly better, all right? We got 22.4%. So we were able to uptick from 18.8 to 22.4. Not bad, right? Not bad, but nothing crazy. But meanwhile, much better than 5.98, right? So we're making progress. So the modified oscillator won. It won. All right. The performance over the entire 20-year period came out to 22.4%, 4 times better than the S&P 500. But I wasn't going to settle for 22.4%. All right. I wanted real money. And remember, folks, remember, and I should have said this a minute ago, these numbers you're seeing, these are the actual asset. Those are not options. If you were doing the option, you can probably add another 0 or 2 to each of them. So when I say 45 to 50% a year, when you're talking about options, the numbers are just astronomical. I mean, if you can make 50% a year on the underlying asset, the number you can make on the option is insane. And I'll get into that. I'll get into all of that. So imagine, get excited about this. 40, now, everybody has an amazing year, you know, or 2 year, maybe even 3 year, where they say, oh, I made 45, 50% return annually. I'm a big shot. I'm an Einstein. Everybody's an Einstein in a bull market, by the way. We're talking 45. Imagine, just think about this, all right? Warren Buffett could barely make 20% over 20 years. Imagine making consistently 45 to 50% return annually. The numbers are crazy. I mean, the numbers are really crazy. $10,000 in 5 years becomes $115,000. That's 11 times compounding. 11 times, folks. That could buy a lot of vacations, a lot of trips, a lot of holidays, a lot of college enrollments, home, depending on where you live, down payments for homes, trips. I mean, you can really change your life at 45 to 50% return. And again, not 1 year, not 2 years, not 3 years, not 4 years, not 5 years, not 6 years, not 7, 20 years consistently. All right. So to get to this, now we have a baseline. Now we see what the best systems can do. So we have to now I'm getting deeper and deeper. What type of stocks experience the biggest gains? And what's the best trigger for explosive price moves? We have to answer those questions. If we can't answer those questions, then we're back to square one. We're back to trading the S&P, or at best trading one of those systems, and we're going to get 22% a year, and that's just not good enough for us. We want more. We're active traders. We're not buy and hold investors. We want more. You guys are here because you want more. So let's see if we can find it together, all right? Here's what I found. Small caps consistently outperform larger stocks because it takes much more volume to move a massive stock. Logically, just think of it. The bigger something is, the harder it is to make it move. They're more bloated, they're more mature, they're more saturated. These stocks, and when I say small cap stocks, I'm not talking about over-the-counter stocks, penny stocks, speculative stocks. I'm just talking about smaller stocks, Russell 2000 stocks, stocks that have a market cap of $1 billion to $2 billion. So companies, imagine Amazon 20 years ago. Imagine Netflix 10 years ago. Those kind of companies. Companies that already have thousands of employees, companies that are already making a lot of money, but companies that haven't become mature enough to enter the S&P 500. Companies that are just rocking it, but have not been recognized yet. You know, tons and tons of companies that and I'll get into the names, but you'll see what I'm talking about. But that's where the money is, all right? The stocks before Amazon became a household name and everybody used it, it was going up like crazy. That's the kind of stock we want, not after it became a household name, all right? So these are numbers. This is just to give you a little taste. And again, I'm numbers driven. Everything I do is based on numbers, all right? And I did this over about 10 to 15 quarters in a random year period. And this is what the typical scenario came out. The lowest was about 4.5, the highest was about 8.5, the average was 6.5. Small caps, whenever you put your money, and again, when I say small caps, don't confuse it with penny stocks. We're talking about something different. When you're looking at smaller stocks, all right, whenever you're putting $1 into a smaller stock, your average gain will outperform a large cap 6.5 times, all right? 6.5 times. No joke, 6.5 times without options. So anytime you put your money, invest your money in a smaller stock, you're right away 6.5 times ahead of a larger cap just by doing that. All right. And again, remember what I told you, even if you don't buy anything from me, if you don't take advantage of what I'm offering, this is worth its weight in gold. All right. So we answered the first question. Remember, what type of stock experiences the biggest gain? These, Russell 2000, small caps, not tiny stocks, small caps. Now, what's the strongest catalyst for triggering intense directional momentum in the price of the stock? That's the second question. If we can't answer that question, back to the drawing board, all right? We got to answer this question. So I'll back into it. I'll have you answer it yourself. Let's see if you guys can figure it out. Tesla's one of the fastest growing companies since going public in 2010. The stock is up 3,000%. So what is, and I mean, this is obvious. I didn't make this chart up, okay? So that means the company must be making money hand over fist, right? Right? I mean, how else? Why else would people be buying this stock, right? Guess what? It has not made a net profit. So now you're thinking to yourself, well, why is it up 3,000% and it's never made a net profit? Well, it's probably because people like Musk, right? They like Musk. They know him. He started PayPal. They believe in him. It's a coincidence. It's one of those flukes, and that's why Roger's talking about it today, all right? So let's just keep that in the back of our mind for a minute, right? How about Zillow? There's no public CEO. I don't even know the guy's name. I honestly don't. I don't know the guy's name. And this stock's not up 3,000%. This stock is up 5,000%. The stock is up 5,000%, and it must be making a lot of money, right? It's not. Okay, so I'm a little confused here. I thought, Wall Street, you buy stocks because they make money. I mean, why not just start a company and lose money and then have the stock go up 5,000%, right? I mean, that sounds like a fun game to me, right? Stock is not making any net income. These are public numbers. You can find these yourself. I did not sit here and make up this balance sheet, okay? Why is Zillow up 5,000%? 5,000%, not 50%, 100%, 200%, 5,000. Do you guys understand 5,000%? And the company hasn't made a dime in net profit. And by the way, not to get sidetracked, but Amazon just recently started making money. Up 8,500%? So it boggles the mind, right? You're thinking, Roger, we're all missing something here, right? So this is why investors believe that at some point in time, Tesla and Zillow will be worth more money. Their present value, this whole business about being up 3,000% or 5,000%, this whole monkey business, it's based on future expectations. It's not based in current value, all right? The entire value, this whole pyramid, it's just a pyramid. And if something goes off, it falls. But right now, and we're talking about some of the biggest funds investing in these companies based on future value. So what did 20 years of data tell us, right? Investors don't pay for what already happened. They don't care. Markets always look ahead and discount everything. And the big moves are in speculation of what could happen in the future. So let me give you a really quick example. Disney. Let's just take Disney. Everybody knows Disney, right? Disney's making money hand over fist. I mean hand over fist. But the stock has been stagnant for years. You know why? Because there's no speculation about anything new or different about Disney. So they add another ride. Big deal. So they add 2 rides. So what? It's nothing. There's nothing magical happening. Disney's not going to start flying the space shuttle to the moon tomorrow. Maybe if they did that, that would be... So everything is based on speculation. And the more speculation you have, the more the stock will go up. And 20 years of data told us that. So I purposely left out the best performer till now. Now, remember what I told you guys? We started at 5.98%. Remember, that's the S&P 500 chart below. Now, imagine you can get over 8 times the performance of the S&P, 8 times. Not 1 year, not 2 years, not 3 years, not 4 years, not 5, not 6, not 7, 20 years consistently. All right? Remember, so far, I've been holding out on you. The best strategy, 22.4%. We were able to get 49.14%. And again, not 1 lucky year, 2 years, 3 years, 4 years, 5 years, 20 years. And all of these are optionable. So if you invested $10,000 in the S&P 500, you'd have $30,777 after 20 years. It's not bad. Again, you know, it's okay. But if you invested in my top strategy and you started with $10,000, you'd have $19 million in less than 20 years. And remember what I told you today? I'm here to make millionaires. I want to grow millionaires, all right? So $30,770 or $19 million. Check out some of these. These are actual trades. SunPower Corp, 59% in 14 days. We get in February 11th. Price doesn't start breaking out till the 14th. By the time you take profit, if you got in on the breakout when everybody was talking about the stock, you'd barely break even. Here, 59% gain. Now let's talk about the option. The same option. 430%. Not in 10 years, not in 5 years, not in 2 years. Remember, the S&P only made 207% in 10 years. 20 years. I made a mistake. This is 14 days. You see why I'm getting so excited? 430% in 14 days. Momentum indicators, they wouldn't catch this trade till 3 days after entry. By that time, it was over. It's, you know how that saying in the movies, it's over, Johnny. Well, it's over. It's over for this stock. Now, you'd break even if you bought the stock, but if you bought the option, you'd probably lose 50% of your investment in those 6 days because of that massive volatility crush. Career education, 48% gain. 48% gain without any notice. The breakout came 2 days later. That option was worth probably double what it was worth on the 7th, on the 10th or 11th or the 12th of November. And by the time you got out, if you got in on that breakout, you'd make a little bit of money. But if you got in before any notice, before anyone was talking about it, before anybody was any wiser, 48%. All right? Now the option, 325%. That's 325% in 28 days. Technical indicators, they wouldn't catch this till 2 days after entry. And again, you know what would happen. All those things we talked about. It's a totally different ways to analyze price action. There's no technical indicators and there's no fundamental projections. Remember, that's what we talked about. I gave you 17 systems, fundamental, and then I gave you 17 systems that were technical. None of it. I've been holding out on you this entire time. Earnings revisions. Earnings revisions drive price. They're the biggest catalyst for price, bigger than anything else. Earnings drive price. Financial analyst firms provide the actual dollar value or price range where they believe price will be, and how quickly price reaches the recommended value depends on the credibility of the firm and how much influence they have. Now, before you start thinking to yourself, I got it, I don't need Roger, I know what I'm doing. Well, it's not that simple. If you only focus on positive earnings revisions, you could really wind up with a massive disasters. If it was easy, everyone would be doing it. And I mean everyone would be doing it. You need the right number of positive revisions from key firms. You need lack of negative revisions from relevant investment firms. Proprietary and momentum revision filters were developed by us. Proprietary stuff took us a long time to get there. Now, this is a good example of knowing too little and knowing enough to be dangerous to yourself. For example, IBM, huge stock, Barclays Bank, they don't mix. It's like water and oil. They don't mix. All right? They just don't. They're terrible. They hate each other. We created thousands and thousands of scenarios like this in our database. And we match the right one. We know what stock is triggered by what company for lasting sustainable effect. So it's important to know which investment firm has the propensity to drastically move the price of the stock. And this is very important. The investment firm can make all the difference in the world, all right? Now, here's the problem. Here's the major problem. There's 4,700 analysts out there, and each one really does specialize in only a few sectors. If the right group of analysts upgrades the stock, you will see massive price appreciation quickly. And I mean quickly, all right? Very quickly, like the examples I gave you. Like this example, remember Overstock. And again, folks, notice the examples I'm showing you. These are not penny stocks. These are not some over-the-counter 35-cent penny stocks. These are stocks that are ready for prime time. 34% gain in 21 days after entry. 21 days, 34% gain. All right? The options, 328% gain after entry. Momentum indicators, they signal the trade 10 days later. There's no fun in that. By that time, it would be over. All right? Chemet Corp, 35% in only 29 days after entry. 35% on the stock without any prior notice. The option, 327% during the same 29 days. Can you imagine coming home and telling your wife you made 327% on your money? That's a holiday. Momentum indicators, they caught the move, but they only caught less than 40%. I believe they caught about 37% of the move. No fun there. No fun there at all. Nothing worse than being right and not, I'm telling you, there's nothing worse than that. So the name of this system, the name of this methodology, it's called Billionaire Breakouts. It's a computerized trading model. It analyzes a basket of stocks to see which firm influenced the price with their recommendation. It includes the number of positive revisions, the number of analysts behind the stocks, their core specialty. But this is not a database. We do all the work for you. We spoon feed you this stuff. We don't just give you a database that says, here you go, have fun with it. There's no fun in doing that. We created an actual system. It targets small caps and mid caps. And again, remember what I told you. It doesn't target over-the-counter stocks or small caps. It only targets stocks that have a market cap of at least $1 billion to $2 billion. So these are stocks that are ready for prime time. They're ready for institutional growth. They just need the right catalyst, all right? And they're ready for explosive gains. For example, a Metasystem, 34% in 21 days. 21 days, folks. That's 21 days, all right? The option, 255% during the same 21-day time period. That's amazing. Keep in mind, these are not bloated, oversaturated companies that already made their fortunes. Huge companies have to see continuous buying pressure to experience gains. Small caps don't need it, all right? They can rise. They start getting exposure from one right company, they can double in value. It's literally the difference between, think of a large cap as a bowling ball, all right? Think of it as a bowling ball, and think of a small cap as a tennis ball. Imagine throwing unless you're the Incredible Hulk or Hercules, that bowling ball is not going to go very far, all right, unless you're a professional athlete. And then even then, that tennis ball, you can probably throw it pretty hard. The reason why? Because it's lighter, it's easier, it's less stress. Same thing with these companies. You could imagine a bowling ball versus a tennis ball. So no penny stocks, no startups, no speculative stocks, public companies ready for massive growth, average value of company $2 billion, market cap of $1 billion. All right? Now, pay attention to what I'm about to tell you. Again, if you and I never do business together, if we say goodbye to each other and never talk again, please, folks, listen to what I'm about to tell you. It's not costing you anything. This is very valuable information, all right? This will help you diversify, lower risk. Remember earlier, about a week ago, markets were tanking? Well, if you held an S&P stock, every one of your stocks would be tanking. You know why? It's called correlation, all right? Correlation. Stocks, large cap S&P stocks, are greatly correlated to the broad market. Small caps are not. They're substantially less correlated. There's a correlation between two assets, all right? Always in stocks and any kind of markets, there's a correlation. The more you can diversify and eliminate that correlation and diversify your portfolio, the more spread out your risk will be. And I don't know if you've ever heard the saying or not, but diversification is the last free lunch on Wall Street. I really mean that, all right? So take a look at these two stocks. That's Delta Airline and another one is United. I ask traders, or trader will come to me and say, Roger, I'm doing exactly what you're saying. I'm diversifying. And then they show me two stocks that are related. That's the same thing as buying twice as much of one stock. You never ever want to play that game, all right? So here's what you need to know. Threshold for correlation is 0.66. If two assets trade near each other 2/3 of the time, it means they're highly correlated. Trading highly correlated assets will increase your profit potential and increase your risk of loss. Remember what I said during the disclaimer. The more upside you have, you can have equal downside. Whenever somebody promises you huge gains, you can have huge losses unless you know what you're doing. So don't trade correlated assets. And here's where the small cap beauty comes from. Look at the correlation between the model and the S&P 500. It's correlated at 0.26. 0.66 is danger zone. This thing is 0.26. And this is over a long time, not over 2 months, over a day, which means you can have your cake and eat it too. What does that mean? That means that the market tanked last couple of weeks and you were just sitting there and no matter what stock you bought, it was going down. Not with this strategy. You want proof? Check this out, all right? This is the performance of the model of Billionaire Breakout in comparison to the S&P 500. You think it's a fluke? Look at every year. Look at every year. 2008, stock market down 36%. We made 6%. And if it was options, oh boy. 2002, 35%. 2001, 71%. 2000, 40%. We beat the stock market every year. Every single year. Not over a year, not over 2 years, not over 4 years, not over 5 years, over 20 years. So, and again, this is the last part. I want you to really focus. Everything I'm telling you is important, really, really important. When you're buying stocks, large cap stocks, remember I said markets are counter trend markets? Well, here's what happens. You get your movement 4 times a year during earnings. This is where the big movement occur, and then stocks just kind of sit there and don't do anything. Well, when you're dealing with earnings revisions, you don't have to wait for earnings seasons for big swings because brokerage firms and investment firms, they revise earnings all the time. So you get opportunity for big moves without having to sit on the sidelines or going from being an active investor to a buy and hold investor and waiting for that opportunity. All right? Check this out. Capital gain, 22% in 7 days. 7 days. That's 22% in 7 days without any notice, no prior warning. The option, 210% in the 7-day time period without any notice. And when you bought this option, nobody knew about it. And folks, this is a New York Stock Exchange stock. It's not even a NASDAQ stock. This is a small stock, but it's no penny stock. This is a fairly big-sized company. So again, we're not trading some minor speculative stocks. Billionaire Breakout keeps you in the stocks that are on the move and options. And we give you both. The strike price, expiration, everything. Positions are evaluated weekly. You buy options and stocks that are ready to move. If there's no action coming your way, you get out. We don't hold options till expiration. We don't let the ice melt. That's not what we're doing, all right? We don't want Eskimos selling us ice. We don't play that game. If a stock explodes, then we hold the position, but we evaluate weekly. Ubiquity Networks, all right? 37% in 22 days. 22 days notice, no prior notice, and it's happened in the middle of August. Sleepy summer, you had nothing to do, you sit tight, 22 days, you cash in. Option gain 746%. Best part, by the time technical indicators caught wind, we were days away from taking profit. These are your peers. finds the needle in the haystack right before the move begins. I didn't believe it till I saw it. After 40 years of investing in stocks and options, you finally nailed it. The market tanked all week and my options are up 20%. That's what I was talking about, how it's not correlated to the stock market. All right. I'm really happy since I started following your advice a month ago. My account is up over 10% in a month. All right. Identify six top stocks and options on a weekly basis. Find stocks that fit my multi-step algorithm. Highly, highly effective over not the last few weeks, not over the last few months, but 20 years. The Billionaire Breakout Portfolio reviews positions every 7 days. You don't have to think about where to buy or sell. Each stock or option gets 7 days to prove itself. If directional movement doesn't come our way, the position is eliminated. It's that simple. And if you trade options, there's nothing to figure out. All you have to do is place the trade. We make it easy. And we give you, folks, if you're in a foreign country, we make it super, super easy for you, all right? We make it super, super easy for you because we give you this 16 hours ahead. We give it to you Sunday night. We send you an SMS alert, and we give you an email. So you know what to do 16 hours ahead of time. And not to gain 21%, 28 days. These are the kind of gains we're talking about. 21%, the option, 1,453%. Now imagine $1,000. Your $1,000 becomes $14,000. $14,000 from 1,000 in less than a month. That's a hero. That's a trading Jedi, all right? Billionaire Breakout is a complete program. You get 24/7 access to Billionaire Breakout Members Portal, order entry instructions. Every 7 days you get an email and SMS alert, and there's daily updates. You get getting started video tutorial. You get unlimited email support, and it goes directly to me. You get daily updates, and that includes my coaching and analysis, and you get a downloadable position tracker, which allows you to see every trade from the time it started, analyze, ask us questions, look at it with a microscope, do whatever you want to do with it. And I know there's a lot of option traders out there. As a special bonus for options traders, we're giving you triple-digit winners. Powerful, powerful stuff. It'll help you get the best out of this program with options. It'll teach you how to select the best option strike prices, how to buy undervalued options. This video alone is worth price of gold. I'm not kidding you. This is really good stuff. It'll teach you everything I've taught you over the years. The program alone, 49% average annual returns over 20 years, explosive 1,453% option gains with limited risk options. The regular price is $39.97, and we have sold out, literally sold out at that price many, many times, all right? Now, today, because we're doing this for Trade Thirsty, we love Jeanette, we want to give you guys a deal, wealthpress.com/breakouts, or call 904-404-8870. I don't believe there's anybody there actually right now, so you may have to leave a message. I would suggest before we sell out all 50 spots, visit wealthpress.com/breakouts, all right? There's only 50 spots left. There's a lot of people coming in here today, and we stand behind this 100%. If Billionaire Breakout does not outperform the S&P, I'll give you an additional 12 months at no cost. And remember, this thing has outperformed the S&P 500. Billionaire Breakouts, this is my top-of-the-line program, and it's outperformed the S&P 500 20 years straight. You get the program. You get bonus number one valued at $1,000. That's my daily coaching and analysis. It gives you a complete top-to-bottom approach to market analysis. You get my captured triple-digit winners at $400. The entire value is over $5,300. You're getting it at $1,497 today. More feedback, up $32,000. Anytime you want to alert me of such lucrative option opportunities, please do so. Getting involved with your company has been one of the best decisions. Folks, don't think twice. This offer will not last at this price. This is a 20-year statistical back-tested system that's been out now for a while, and it works really well. wealthpress.com/breakouts. Again, you get the coaching, you get the capture triple-digit winners as a bonus, and most importantly, you get the program Billionaire Breakouts, 1,453% returns, $14.97. Don't think twice. Go to wealthpress.com TradeThirsty.com/breakouts. Now, let's see if we got some questions here. All right here. If you don't know how to trade options, we will teach you how to do it with these programs and these videos. And if you have any questions, we will get it for you. No, there's no front running because we have, that's a great question. No, these are actually big markets. These are Russell 2000. There's no front running. We've actually never ever once had someone email us and said that they missed a fill. We give you a limit order with a price range, and we've never once had an issue with that. So it's been extremely, and Remy, I gave you several examples of options actually. Let's see. We have over 65 to 70% winners, and the option winners are a lot bigger than the losers. We give you the guarantee we have. We stand behind the guarantee. If we don't make the returns, if we don't outperform the S&P, you get the next year on us. And yes, we're trading the 6 options, and they're not weekly options. Sometimes we hold the option for a week, but if it moves, we'll hold it for a while. Or if 3 of them moves, we'll hold them for a while. So next week you'll only get 3 options. But the portfolio holds 6. So because we don't know which one is going to make the move, which one won't make the move, we want to get the best opportunity. So we want to hold 6, and we cut them right away. And we don't buy options that are expiring. We buy options and we sell options. So if nothing's happening, we offset them in 1 week. We released a system a while back. Yes, this is Roger Scott. Yes, this is Roger Scott. How do I manage the trades? We manage the trades for you. We have profit targets, and we liquidate the trades over a year. The performance since the beginning of I don't have it here, but it's been very, very solid. We don't do puts. We only do calls because there's no correlation with the rest of the stock market. So yeah, we've had this system now out for release for I believe about 8 or 9 months. So, and the options have been some of the options have been just killing it. I mean, really, I believe the current rotation is up about 11% or 12% just over the last few days. So the options really, really move. And again, folks, you get a track record of all the trades. Everything is presented. Go to wealthpress.com/breakouts. There's only 50 spots left, and these things are going to go. I mean, they're going to go. So let's see. Yeah, and one thing about this strategy that's really, really cool, you don't buy options. You don't buy options that are expiring in a week. We're buying calls that are slightly out of the money. We're buying them with 45 to 60 days, and sometimes we're only holding them a week. So even if the stock doesn't move, we're liquidating the option, we're scratching the trade, and that's really great because you're not buying options, you're not loading yourself up with all these options that are just expiring. So we don't do that, all right? We don't do that at all. And you don't need a large account for this. $2,500, $5,000 is more than enough because think about it. Each option is just a couple $100. These are not Amazon stocks where the option's $80, okay? These are stocks where the options are 50 cents, 60 cents. So to buy one contract, you have to spend maybe $200 or $400. So even 6 of those, it's not one of those things that requires a huge account. It's not something. Thank you, Steve. I appreciate the nice words. So yeah, there's not a lot of expenses here. Yes, you get text alerts. You get them Sunday. You don't do anything till Monday. So there's nothing. You can use any platform you want. You don't need to have a large account. You could trade. We've had traders starting this with $2,500. You could. We've had traders who use Robinhood for this. Thinkorswim. We've done live trades on air with the system with Tasty Trade, Express Trade. Any of those will do. The cheapest one is the best. Interactive brokers, very reasonably priced ones. I'm not recommending any of them to you because they're all good. All the ones I mentioned are good. Yeah, we have a lot of questions from people who live in foreign countries. It's not an issue. For some reason, we have a lot of American clients who live in Singapore and in Asia. It's not an issue at all. We tell you we give you money management. We give you the size for each trade. We tell you how much of your account to allocate to each position, folks. So you never have to wonder what to do. You never have to wonder how much to buy, how much to sell. And again, we give it to you 16 hours in advance. So if you have any questions, you can email us, and we're there 7 days a week. We're always answering questions. I mean, look, I'm here Saturday morning. So yeah, there is money management. And if you have a large account, there's two ways to trade it if you have a large account. What I would do is I would allocate a very small portion of that account. That would be the best way to do it, in my opinion. I wouldn't trade a whole large account, and the reason I wouldn't do it is because you don't need it. With profits like 600%, 1,453%, you don't need it. You don't need a huge account for this. I recommend a small account. One of my best traders ever was a tiny account trader. We don't use call spreads. We just buy the outright calls, so you could trade it in an IRA account. It's completely IRA friendly. If you have a big account, you just take if you have a, let's say, $100,000 account, take a $5,000 or a $10,000 account and allocate it to this. And don't even allocate it to the option. Allocate it to the stocks, see how it goes, give it 3-4 months, get the propensity for the system, and then move into the options. Be a smart investor. Visit wealthpress.com/breakouts. All right? There's no spreads here at all. We don't use any kind of spreads. It's clean option buying, and we match the deltas, so we give you options that'll give you equal exposure.